Yes, this is a video on Chapter 16 on working capital management. And what I will do is go through a couple of the problems in the back of the book so you can see them worked out on the blackboard. The first one we're going to do deals with our cost of trade credit. And it's dealing with a company that buys $8 million worth of materials, and they have terms of 3% if they pay in 5 days, net due in 60. And again, they buy $8 million worth of materials. So then what the problem is going to ask is, what is the cost of that trade credit? So what we do with that is we take our percent that we're saving, so we're saving 3% over our percent paid, which would be 97%. So if we save 3% due to our cash discount, we're going to pay 97%. So again, we're saving 3% if we pay in 5 days. So then we're going to multiply that times 365 over top of our difference between the day that we need to pay to get the cash discount and the net due date. So that would be 55 days. So that would be 60 minus 5, the net minus the 5 days. Then you can solve this type of an equation a couple different ways. What I normally do is I multiply it straight across. So I'm going to take 3% times 365, and that gives me 10.95. And then I'm going to take 97% times 55, and that gives me 53.35. And then I'll divide those. So 10.95 divided by 53.35, and that gives me 0.2052, or 20.52%. And then that is the cost of the free trade, because again, this is like a supplier that's giving us that deal. We don't have to pay any interest, but if we pay in those 5 days, we're going to end up saving money. So that would be our cost of free trade. And then even if we borrowed money, we would still probably be money ahead as long as our cost of free trade is greater than the amount that we borrow. So say, like, go back to this $8 million. If we're going to save 3% of that, that's going to be a decent amount of money because, again, the large amount that we're purchasing. So we're going to have a $240,000 cash discount. Even if we had to go borrow, let's say we had to borrow at 10% from our line of credit. And again, the formula I'm going to use, hopefully this will kind of come back to you, for this borrowing at the 10%, it's our interest equals principal times rate times time. So just basic, your simple interest formula. So then we would have we'd have to borrow, we'd actually have to borrow the net. The $8 million is not what we'd end up paying if we're paying it early because we're saving that $240,000. So we'd actually have to borrow $7,760 net of the discount at 10%. And then all we focus on again is these days, because we'll have to pay on day 60. We don't have to pay on day 5, we can wait for 60, but if we pay on day 5, we're going to save the $240,000. So that is only 55 days that we're borrowing that money for. So then now if I put that into my calculator, 7,760,000 times 10% times 55 divided by 365. Let me do that again real quick, hold on. That gives me $116,931.51 that we would be paying in interest. but it would still be worth it. So we're still going to save $240,000. Now we may have to pay $116,931 in interest, but if we compare those, we're still money ahead. So we would still be saving $123,068.49. So that's kind of how I'll have it on the test, where you're gonna calculate that cost of the free trade. Then you're gonna apply it to say, okay, well, if this is really my scenario and this is how much am I buying, how much will I save by taking that cash discount, and then how much am I paying in interest? So then that is, again, going to be one that you'll want to understand for your test. Okay, then we have number 4, which deals with our cash conversion cycle. And that one is a fairly easy one, as long as you have your formula. So if we have a scenario that we have a inventory period of 75 days, a collection period of 38 days, and a payables period of 30 days. So collection period of 38 days, and a payment period of 30 days. And so we're trying to get, whoops, I'm going to start with one step first. We're going to do our operating cycle first, and then we will do our cash conversion cycle. So our operating cycle is the entire time from the day that the inventory comes into the plant until the day that we collect the cash on the sale of that inventory. So that is our inventory age plus our collection period. So we can add those two together, and that gives us 113 days. But unless we pay COD, unless we pay the delivery guy as he delivers us that material, we're really not out the cash those entire 113 days. So then we take the 113 days and we subtract how long on average it takes us to pay those invoices as they come due. So that's going to be 30 days. So then if we subtract 30 from the 113 days, we're 83 days out on the cash. So then that is another one that you'll want to know for your test for this chapter. But again, I feel like that's a little easier of one as long as you know your formulas. Then the third one out of this chapter we have is our cash budget. So the cash budget will only do 1 month. And then we kind of map it out to say, okay, first we're going to focus on our cash receipts, and then we'll map out how that cash is coming in, and then we'll compare that to our cash payments. So this one can be a little bit longer of a scenario though, but so we have, say if we have sales, that they're going to give us estimated sales for a series of months. So if we are going to focus on September sales, then as we read it, it tells us that the payments that they collect, they'll collect 10% in the month of the sale. Then they will collect 75% the month following the sale. And then the final 15%, like kind of those stragglers that take a little longer to pay, will go out to the second month following the sale. So if we're focused on September, and if we have that type of a payment plan, we're going to have September cash receipts. We're going to go back to August, the month prior, and then we're going to go back to July, the month prior to August, because again, we're going to collect so much in the month of the sale, so much the month following the sale, and then those stragglers will come in 2 months following the sale. So we always have to kind of go back in time. So then if I look at those sales, the September sales are $720,000. The August sales are $540,000. And then our July sales were $360,000. But obviously we're not collecting all of those amounts in September. We're collecting just a percent of them. So we go back to that estimate. So 10% of September sales will be collected in September. 75% of the prior months will be collected. So that will be 75% of August will be collected in September. And then finally, again, those stragglers are going to go out 2 months, and that's 15% that will be coming in from July's. So then now we have to apply our percentages. So 720,000 times 10% gives us 72,000. 540,000 times 75% gives us 405,000. 360,000 times 15% gives us 54,000. So then now we'll add those three up. And we get $531,000 will be our total cash receipts. So you got to, again, tier them as they estimate them. Then we want to focus on our cash payments. So then it comes down and it gives us various costs, which are labor plus our raw material for the different months. And it tells us that we have, that they'll normally be paid the month after the services are provided. So again, we have some payment terms. We're not paying that labor and those materials right in the month that we're acquiring them, we're paying them a month later. So if we're focused on September, we have to go out to, or go back to August's materials and labor. Again, because it will be 1 month out in our payment. So August's material and labor is $882,000. Then it tells us that we have general and administrative salaries that are $27,000 a month. And those will be paid every month, so every month's going to have that in it. We have leases of $9,000. And again, those would be an every month kind of a charge. Then they tell us depreciation, but then they're testing our knowledge there. We know that depreciation is just a journal entry. It's not cash, and what we're doing right here is our cash budget. So we only care about money that's actually going out the door. So depreciation is not that. Then we have miscellaneous expenses of $2,700, and again, those are every month. Then we have tax payments. So we have tax payments that are due in September and December. So we are in September, so that is $63,000. It wouldn't be every month, but when you're in those particular months of September and December, you have to include those. And then there's a payment in October that we're not concerned about. And then it tells us that our cash on hand is $132,000. But we would like to maintain at least 90. So we'll come into those, but right now I'll add up my cash payments. So 882,000 plus 72,000 plus 9,000 plus 2,700 plus 63,000. That gives us $1,028,700. So we obviously have way more payments than we do cash receipts. So then now we come and say, okay, what's our beginning balance? It tells us in the problem that the beginning balance is $132,000. We add to that our cash receipts, and those are $531,000. So then our cash on hand is $663,000. But obviously that's still not enough. So then we subtract out our cash payments. And that's a big negative number. So it's a negative $365,700. So that's not good. So that if we have this negative cash flow situation, then what that tells us is we need to borrow. So we need to borrow money because we don't have enough money coming in to pay the cash payments going out. But then we don't want to just borrow the $365,700 because the problem tells us that we would like to maintain $90,000 in that account. So we're really going to actually borrow that plus $90,000, so that's going to be $455,700 that we are going to borrow. And then if we borrow that amount, then we will be left with $90,000, and that is our desired ending cash. So then you'll have one like that on the test. And again, I feel like that one's the hardest one. There's a lot of steps to it. You got to read carefully, map out your cash receipts in accordance to how the collection comes in, pay attention to how the payments are being made, and then put it in to determine if they have borrowing needs, and then make sure they're borrowing enough to bring it up to that desired cash balance. So then that too will be a problem that you will need to know for your test. And then that completes this particular chapter.